Imagine waking up one morning in India, walking into your bank, and finding out it's no longer Indian. The Dubai bank now controls it. A New York private equity giant is its largest shareholder. And a Boston investment firm has just launched a takeover offer for even more. This is not a movie plot. This happened in 2025, and the deals are still closing in 2026. 3 deals, 3 global giants, over $4 billion flowing into India's banking system. Today, we are breaking down the most explosive foreign takeover wave India's banking sector has ever seen, and what it means for every person who has money in an Indian bank. Here's the thing most people don't realize about banks. You think your bank is Indian, the name is Indian, the branches are everywhere, the teller knows your face, but banks aren't restaurants. The person who owns the kitchen can be on the other side of the planet, and India actually allows this. Up to 74% of a private Indian bank can be owned by a foreign company. That is not a loophole, that is the law. What it requires is a green light from 2 of the most powerful financial regulators in Asia, the Reserve Bank of India and the Competition Commission of India. Every deal we're covering today has cleared those gates or is in the final stages of doing so. So the question isn't whether this is legal, it is. The real question is, why are 3 of the world's biggest investors all rushing through that door at the same time? On October 18, 2025, Dubai's Emirates NBD Bank announced it was spending $3 billion to buy 60% of India's RBL Bank, the largest foreign direct investment in India's financial services sector ever. Then, in April 2026, the Reserve Bank of India formally approved the deal, and the approval was bigger than most people expected. The RBI didn't just clear 60%, it approved Emirates NBD to acquire up to 74% of RBL Bank, the maximum allowed under Indian law. Emirates NBD must hold at least 51%, making it the official promoter of RBL. Once the transaction closes, RBL Bank will no longer be classified as an Indian private sector bank. It will be reclassified as a foreign bank subsidiary with Emirates NBD in Dubai as its overseas parent. That has never happened before with a profitable, listed Indian bank. This is not a minority investment. This is a full structural takeover, approved, documented, and moving through its final regulatory steps. Here's the chess move Emirates NBD played, and it's worth understanding because the world's biggest deal makers use this same move again and again. They didn't walk into the open market and start buying RBL shares. That would have driven the price up overnight, tipped their hand to competitors, and spooked other investors. Instead, they went directly to RBL's board and said, create new shares, just for us, at a fixed price of 280 rupees per share. That's called a preferential share issue, surgical and private, entirely legal under Indian securities law. But Indian law has a tripwire built in. The moment any investor crosses 25% ownership in a listed company, they must make an open offer to every other shareholder, giving regular investors a chance to sell at the same price. Emirates NBD triggered that wire twice. The first open offer ran through December 2025. A second open offer for an additional 26% of shares followed the April 2026 RBI approval. One deal, multiple stages, every step watched by Indian regulators. Nothing moves without their permission. While Emirates NBD was navigating India's regulatory maze, New York's Blackstone, the largest alternative asset manager on the planet, was quietly clearing its own path. In October 2025, Blackstone announced it would invest $705 million in India's federal bank for a 9.9% stake, making it the single largest shareholder in that bank. By February 2026, the Reserve Bank of India gave its formal approval. All major regulatory clearances are complete. Now Blackstone is famous for buying office buildings, hotels, and companies. But a bank, that's new territory. And it tells you something important about where the world's smartest money sees opportunity. Here's how they structured it. Federal Bank issued convertible warrants. Financial instruments Blackstone can convert into actual equity shares over an 18-month window. Think of warrants like a rain check at your favorite restaurant. You pay now, you get your table later, at a price locked in today. Blackstone paid 25% of the price up front. The remaining 75% is due when it converts those warrants into actual shares. And upon full conversion, Blackstone earns a seat on Federal Bank's board of directors, America's biggest private equity firm, at the table of an Indian bank boardroom, with every regulatory door officially open. And then there's Bain Capital, out of Boston, one of the sharpest private equity firms on earth. In March 2025, Bain announced it was acquiring an 18% stake in Manappuram Finance, India's second largest gold loan company, for $508 million. That initial acquisition gave Bain joint control of the company alongside the founding family. But Bain didn't stop there. Under Indian securities law, that acquisition triggered a mandatory open offer requiring Bain to offer to buy an additional 26% of Manappuram from public shareholders. That open offer was launched in April 2026. If public shareholders tender their shares in full, Bain Capital's total stake climbs from 18% all the way to 41.66%, making Bain the dominant shareholder, outweighing even the founding family. Why gold loans? Because in India, millions of families borrow money against their gold jewelry when they need cash fast. Manappuram serves over 6.5 million customers through more than 5,300 branches. That's deep, rural, grassroots financial infrastructure, exactly the kind of underpenetrated market that private equity firms dream about. You don't spend $4 billion in one sector in 1 year by accident. Something shifted. Three forces converged at exactly the same moment. Force 1. India stopped being a future story and became a right-now story. In 2025, India officially became the world's fourth largest economy, surpassing Japan. The IMF confirmed India is growing at over 6%, faster than any other major economy on Earth. Its middle class already numbers in the hundreds of millions, projected to reach 715 million people by 2030. For global investors, India is no longer a bet on the future. It is a present tense opportunity. Force 2. India's mid-sized banks were quietly starved for capital, not failing, but constrained. Banks like RBL needed fresh capital to open branches and extend credit fast enough to match India's growth. Foreign money solves that problem instantly, and critically, the banks actively wanted these deals. Force 3, and this is the one that rarely gets discussed, India opened the door on purpose. Deals that would have stalled in approval limbo just a few years earlier were cleared by the RBI, by the Competition Commission, by the government. India made a deliberate, calculated choice to welcome well-capitalized foreign partners into banking, not as a surrender of sovereignty, but as a signal of confidence in its own financial future. When the economy is the fastest growing in the world, the banks need fuel to keep pace, and the government waves you in. That is not a coincidence. That is an invitation, and the world's biggest investors accepted it. I want you to think about someone you know, a parent, a grandparent, someone who has banked at the same branch for 30 years, who trusts that bank the way they trust the post office. It's just there. It's Indian. It's reliable. Now a Dubai-based bank owns 60% of it, and India's own central bank cleared that ownership all the way up to 74%. Does that actually change anything? Here is the honest, complicated truth. It might genuinely help them. More capital means more loans for small businesses, more branches in underserved towns, a stronger balance sheet that doesn't buckle when the economy hiccups. The bank gets stronger. That's the real upside. But here is the question that serious analysts are asking. When Emirates NBD needs to show its shareholders back in Dubai a solid return, does India's rural borrower become a lower priority? When profit demands and social lending come into conflict, who wins? That is precisely why India built the guardrails it did. Foreign ownership is capped at 74%. Voting rights are capped at 26%. Even if you own 74% of the shares, the RBI must approve every significant move. The safeguards are real, but so is the tension. And the most financially literate thing you can do is keep both in mind and keep watching. Somewhere right now, there is a 28-year-old watching exactly these headlines and running the same math that Blackstone and Bain Capital ran, just at a smaller scale. They're not buying a bank. Maybe they're looking at an accounting firm in their city, or a manufacturing unit that's been family-owned for 40 years and is starved for growth capital, or a franchise with loyal customers and a weak balance sheet. But the logic is identical to what happened across India's banking sector in 2025 and 2026. Find an asset that genuinely works, but cannot grow because it lacks capital. Bring the money, negotiate a structured entry with formal governance rights, and use the complexity of the deal as your advantage because most buyers won't bother to figure it out. That complexity is your moat. Here's what Blackstone understood about Federal Bank that most people missed. The bank already had the customers. It already had the branches. It already had the relationships. Blackstone didn't create that value. They identified it, priced it correctly, and structured a deal, convertible warrants with an 18-month conversion window that protected them if the thesis went wrong. That last part is what separates investors from gamblers, not the size of the check, the discipline of the structure. You do not need $700 million to think this way. Here's what I keep coming back to after studying these 3 deals. India spent decades deliberately keeping foreign hands off its banking system. There are real scars in that history: colonial-era capital extraction, financial instability, the hard-learned lesson that foreign money doesn't always come with aligned interests. And yet, across 2025 and 2026, India's own regulators, its own central bank, its own competition authority said the time is right. Come in. $8 billion flowed into India's financial sector in just the first 9 months of 2025 alone, a 127% surge over the year before, and the approvals kept coming well into 2026. Was that the right call? The deals are too new. The outcomes are still being written. We won't know for 5 or 10 years whether this was the moment India arrived on the global financial stage or the beginning of something more complicated. But I know this: the people who made these decisions are not naive, and the people watching them, that's us, should not be either. Drop your honest take in the comments. Do you think this wave of foreign investment is good for India, or is it a risk the country will regret? I read every single comment on this channel. If this video made you see money differently, share it with one person who needs to see it, and subscribe because the next story makes this one look like a warm-up.